All right, well, let's talk about some of the issues and challenges which you're going to have to deal with in this chapter dealing with inventory costing and capacity. So I'm going to scroll through the objectives. You can read those. Uh, now, let me kind of make a distinction here that in this chapter, there are really two independent issues, although to a certain extent, the choice of denominator does affect the cost. But a lot of the chapter is focusing around this issue here, and that is what costs go into inventory, what costs are excluded from inventory under absorption costing versus variable costing. And we'll look at the particulars of that here in just a minute. The other issue in the chapter, which is sort of independent, but as I said, the denominator level of capacity, and that is how much of the fixed manufacturing overhead go into each item that I produce, does have an impact on it. But the choice of capacity, the choice of that denominator, is independent of the cost. And that leads into some other major management decisions that have to be made. Now, the two big methods I'm going to talk about here, and we're not going to really worry so much about throughput costing, variable costing versus absorption costing. Well, all of you have prepared a variable cost income statement and different types. And the objective with variable costing income statement is to come up with contribution margin and then finally operating income. Well, under variable costing, as I said, remember that the world is sort of made up into two things. One is that variable cost and fixed cost. And fixed costs are, by their very definition in variable costing, always treated as a period cost. No matter how, when, and where the fixed costs are incurred, they are expensed as incurred under variable costing. Therefore, the only cost that will go into inventory as I produce it would be variable manufacturing cost. Now, as we'll see here in a minute, you also have variable non-manufacturing, but those do not enter into the cost of an item. Only manufacturing costs can be included in the cost of inventory. Under variable costing, we're making it fairly exclusive and saying, yes, but only variable manufacturing. We're still going to calculate contribution margin, operating income, etc. Many companies will use variable costing for internal decision making. So the trick is, okay, if you're going to do variable costing, can I convert from that into the next one? We're going to talk about absorption costing. Absorption costing is what is required under GAAP. That is, GAAP says, look, okay, the world is made up of manufacturing and non-manufacturing. If it's a non-manufacturing cost, it's a period cost. It gets expensed. And GAAP says that any and all manufacturing costs, basically anything that occurs within a factory, must be included in the cost of goods manufactured and therefore into the cost of the inventory that you're producing. It doesn't make any distinction between fixed and variable. It just makes the distinction between manufacturing and non-manufacturing. Now, there are good points and bad points about all of these methods, but the chapter tends to emphasize, from a decision-making point of view, variable costing tends to be a little bit better in the sense that you get consistent results. As you increase sales, your operating income will go up. As you decrease sales, operating income will go down. And it really emphasizes, number one, the most important thing a company can do is to focus on sales. The problem with absorption costing is that at times, and it may not always be obvious from some of the examples that you'll see here, sales can go up, but operating income can go down. Because operating income is not only a function of sales, but also a function of inventory levels, any kind of variance the volume variance I need to deal with, and also too the choice of management to repair or not to repair machines can affect that. So let's take a look here at the particulars. All right, as I think we talked a little bit about the differences here. The issue here, the fixed manufacturing overhead cost, okay? And the difference between the operating incomes under absorption versus variable comes down to taking the fixed manufacturing overhead, dividing it by some level of production, and that gets attached to inventory at absorption costing. Under variable costing, it's expensed. So the differences in the incomes between the two can be explained by changes in inventory. That's the big issue here in this chapter. And we'll look at some examples of that here in a minute. So now, let's take a look at the application of variable costing versus absorption costing in one particular year. Now, let's emphasize a couple of things. One is that they are manufacturing 8,000 units, but they are selling 6,000. Therefore, they end up with an ending inventory of 2,000 units. Okay? So anytime inventory changes from the beginning to the end of the year, you will get differences in the operating incomes. Sometimes it'll be absorption will be greater, sometimes it will be less. Okay? Now, revenues are revenues. It doesn't make any difference what method you choose. Now, the strict definition of variable costing. Okay, we have beginning inventory of 0, and in this case, the only costs that we're allowing to go into inventory are the variable manufacturing cost. And since they produce 8,000 units at $200 of variable cost per unit, the so-called total variable manufacturing costs are $1.6 million. Now, they have 2,000 units in ending inventory, so to calculate my variable cost of goods sold, then take the total manufacturing cost minus my ending inventory, gives me my variable cost of goods sold. Now, remember that the variable statement says you have to calculate this thing called contribution margin. So the other variable cost I need to work on are my marketing cost. And marketing costs are a function of sales, not production. So be careful as you're doing these statements that you're real clear about what is the driver of the cost. Is it production or is it sales? So I have my variable cost of goods sold of $1.2 million, my variable marketing cost of $1,110,000. So my contribution margin would be the $3,690,000. Now, under variable costing, fixed cost, the fixed manufacturing of $1,080,000, the fixed marketing cost of $1.38 are by their definition a period cost. They simply get expensed. So I end up with the $1,230,000. Okay. All right. Now, the nice thing about variable costing, as I said, from an internal decision-making point of view, anytime I increase my sales, if I were to sell 9,000 units next year, I would know that my operating income will always go up. If I sell less, it will always go down. I cannot make that same assumption under absorption costing because I am working not only with sales affecting operating income, but also to a great extent, the changes in my inventory. All right, now let's take a look at absorption costing. And to a great extent, as I said, you have pretty much looked at absorption costing before, so there's really not anything new or different with this. So sales are sales. Now, you can do this any one of two ways. One, kind of emphasize, okay, the fixed manufacturing cost per unit. Go back to the $1,080,000 of total fixed manufacturing overhead cost, and you divide it by the estimated level of production, or the capacity, the denominator of 8,000, and you come up with $135 per unit that's being manufactured. So again, this is sort of my denominator level, namely the 8,000. Take the 8,000 times the 200 gives me my variable manufacturing cost. The 8,000 times 135 gives me my 1,080 or 1,080,000. So my total cost of goods available for sale, the 2,680,000. Now, in valuing my ending inventory, okay, I have 2,000 units, and the value of that would be the 200 plus 135 or 335. So the value of ending inventory here is 670,000. Okay, therefore my cost of goods sold, traditional measurement, 2,010,000. I end up with gross margin of 3,990,000. Under the traditional method, down here are my non-manufacturing. Up here, in getting to cost of goods sold and gross profit, are all of my manufacturing. So the line here, if you will, is between manufacturing and non-manufacturing. Here, the line is between variable and fixed. Okay, so I end up with a operating income of 1.5 million, which is conceptually what I would have expected. That as my inventory changed from 0 to 2,000, I would expect that my operating income under absorption costing would be greater. Why? Because I attached $135 per unit of inventory produced. Now, under variable costing, all 1,080,000 got expensed. But because I manufactured 8,000 units and 75% of them were sold, but 25% of them, that is 2,000 units, were not sold. They're still being held in inventory. They're still being held as an asset. That $135 per unit was capitalized to it. So the $135 per unit, okay, if I take this times the 135, see if I can do my writing here, that will equal the difference between the two, the 270,000. Okay, so hopefully you can read my writing with my new mouse here. Okay, so my difference here, 270,000, is attributable to the change in inventory. The fact that inventories went up, sales weren't quite what they thought they were going to be, and so they held back 1/4 of the fixed manufacturing overhead. It wasn't expensed. Okay, so that the change. There are two things that affect the differences in inventory. One, the change in inventory. Two, the fixed manufacturing cost per unit. Now, you can look through this. I'm not going to spend tons of time looking at all this. Okay. In 2014, they started with 0, manufactured 8,000. They sold 6,000, so they end up with 2,000 units. So they carry that over into the next year, okay? And they manufacture, they have 2,000 units there. They manufacture, see if I can read it, 5,000 units, and they sell the 6,000. So they end up with 30 units left in ending inventory. So they realized their mistake, they ratcheted back production, and they adjusted the inventory. So you're going to see some fluctuations here, okay? Nonetheless, okay, sales did go up, okay? Since the print is so small here, I'm going to increase this a little bit. Okay, maybe this is a little bit easier to read. Okay, yeah. All right, sorry about the delay there. I had to get my book out so I can read the writing here. Okay, so they end the year 2014 with 2,000 units. They carry that over. They manufacture 5,000 units in 2015. So they have available 7,000 units. They sell 6,500. So I'm sorry, the ending inventory here would be 500 units. So again, they're kind of adjusting inventory on the fly and trying to, over a period of time, to try to get production and inventory, its production and sales, to be pretty much equal to each other. Okay, so the variable costing, I'll let you take a look at there. Nothing really earth-shattering different than what we've seen before. The same thing would be true with respect to absorption costing, pretty much the same thing that we've seen before. But I would highlight two things that are different. Okay, one is that you have a so-called production volume variance. Now, what does that mean? Well, it means that they planned at the beginning of 2016 to produce 8,000 units. And in reality, that didn't happen. That what happened was that they only produced the 5,000. So they're 3,000 units off. Okay. Whoops. So the 3,000 units, okay, whoops, which is the 3,000 units times the 135 gives you the volume variance. So what does that mean? It means that under absorption costing, all of the manufacturing cost must be included. It doesn't matter, okay, if you incurred it, they must be there. So even if your production is less than what you anticipated, then what ends up happening is that you didn't apply all of the fixed manufacturing overhead because you thought you were going to do it on the basis of 8,000 units. Well, with 5,000, you're 3,000 units short, so you have to make this adjustment. You have to add it to the cost. And typically the way it's done, as I said, what you have to be careful of is that what they're doing is adding it to cost of goods sold. So be careful with the pluses and minuses here. What I like to do is to go through and just simply say, here's cost of goods sold, and then add that to it, okay? You can kind of adjust the numbers anywhere you want within the income statement. There's not necessarily a right or wrong answer. You need to have cost of goods sold, but between the inventory figures and the eventual calculation of cost of goods sold, you can put the numbers in pretty much anywhere you want, okay? And remember, cost of goods sold is going to be subtracted from revenues to get at your gross profit. So be careful with the pluses and minuses here. That just realize that the $405,000 is being added to cost of goods sold to increase it, to allow for all of the manufacturing costs to be included there. Likewise, the other big issue here is the differences in the operating income, okay? And if we want to look at this, and this is kind of the moral of the story, okay, in this chapter. In 2014, inventory levels went up. So what that means is, okay, fine, there's kind of a management issue in terms of be able to handle the inventory. But from an income statement point of view, it means that when inventory levels increase from the beginning of the year to the end of the year, and let's just make our comparison based on absorption costing. It means that if inventory levels go up, absorption costing will have more operating income than does variable costing. Why? Because I'm holding back some of the inventory. All right, it's not all being recognized as an expense like it was under variable costing. Now, in 2016, you get just the opposite. What ends up happening in 2016, the absorption costing will have less. Why? Because I decrease my inventory. It went from 2,000 units down to 500 units. Okay, so by very definition, if inventory levels decrease from the beginning of the year to the end of the year, absorption costing will have less operating income. Well, why? Well, two things. One, in 2016, I'm required to recognize all of the manufacturing overhead. And so I have not only what was sold, okay, but I also have this volume variance. That has to be added in there. Well, in addition to that, okay, I also have the phenomena that, that of that 270,000 of fixed costs sitting in here at the end of 2014, that was all deferred, postponed, and it's recognized in 2016 or 2015. So in this year, you're recognizing not only the current year's manufacturing overhead, but a big chunk of the previous year's manufacturing overhead. So it's almost like, okay, I'm going to hold back some of this stuff and we'll recognize it in the next year. So yeah, and in this case, yes, sales did go up, so my operating income, and actually, here's the situation that I was talking about. Okay, in this particular case, from the beginning of the year, from 2014 to 2015, sales went from 6,000 to 6,500. Okay, well, you think, okay, what's the big deal? Well, the big deal is that 500 units, okay, if I compare the 1.23 million to the 1.5 million, my operating income goes up. Okay, my sales go up, my operating income goes up. So there's consistency between the emphasis sales and the ending result, operating income. Well, under absorption costing, you get exactly just the opposite. sales go up, okay, and in 2014, my operating income is 1.5 million. But in 2015, when my sales go up, my operating income, in fact, goes down. So it's really confusing for management to figure out, hey, what's going on? We're increasing sales, but our operating income is going down. And that's really the major virtue of variable costing. All right, now, I'll let you look through all this in terms of how you could potentially handle that. To, if you want to continue using absorption costing, do you penalize management for running up inventory? Do you set their bonus evaluation over a longer period of time rather than year to year so that you prevent them from manipulating both inventory and operating income? So there are a lot of things that you can do to kind of not necessarily have to make wholesale changes in your accounting system, but you can change the way that you compensate people. Now, throughput costing, we're not going to really worry too much about in terms of calculation. But I may ask you a question or two more conceptually. Throughput costing is kind of an extreme version of variable costing. And what it does is says, look, the only cost that ends up in inventory is direct materials. Labor is normally treated as a fixed cost. Why? Because we guarantee labor a certain amount of money per year. And if they're working the same number of hours, or if they're guaranteed a certain amount of money, well, okay, let's just treat it as a fixed cost and expensive. So yeah, it gives you the same results. Sales go up, operating income goes up, but the problem with throughput costing is that it's very difficult to explain. The other conceptual problem with throughput costing is that in reality, direct materials can also be seen as a fixed cost. And that is, if I'm entering into an agreement with a supplier to say, okay, I guarantee, I promise I'll buy a certain number of units this year at a certain price, well, what's the difference between that and promising labor a certain amount of hours at a certain price? So given those two problems potentially with that, most companies kind of shy away from throughput costing and use variable costing. All right, capacity. Capacity is in many ways the premier question that any company has to answer. And it's a particularly difficult question for a startup company that has to make a huge investment in fixed assets so that they can produce a certain number of units. And so it requires, the problem is, it requires a large amount of capital to buy the right amount of equipment. And those financing costs are very, very high. And you can't keep going back to the market every year or two to say, oh, I need to expand production. I need to expand production. You can do it maybe once every 5 to 7 years. Okay. Now, at the same time, you have the problem. I have to find that right amount. I don't want to overbuy and find out I have too much money in my fixed equipment. That presents an opportunity cost. The money could have been used elsewhere. And I have to get a return of that cost. That means I'm going to have to charge more for what I'm manufacturing in order to earn a profit. If I have too little capacity, it means I can't potentially meet the demands of my customers. And also, too, I'm going to maybe have to go back into the equity markets or to the bond markets or get long-term financing to increase my production. So finding that sweet spot is very, very difficult. And primarily, it's not really an accounting issue. The issue of capacity, okay, we'll talk about what these mean. This is a marketing issue. It comes down to understanding the market. It comes down to understanding sort of the regional market, the local market, my particular product, where it fits into that market, what do I expect the demand to be in the coming year, what do I expect it to be over the next 5 to 7 years, okay? You probably don't want to go much more beyond 7 years. But this requires a lot of analysis, a lot of good grunt work by the marketing people to come up with some good numbers. You don't do this on fly by night or by the seat of your pants. because this can lead to catastrophic results if you don't make the right choice in terms of capacity. Now, if we kind of start from this top and work down, theoretical capacity is looking at, you've kind of made the decision, okay? But the assumption here is that how many units can my machines produce if I run 24/7, 365 days per year? What's the maximum level, okay? So this is kind of an extreme. In the real world, theoretical capacity simply doesn't work because inevitably you're going to have some shutdown for maintenance. You're probably not going to be able to run 3 shifts unless there's just an incredible demand for your product. So what's a more realistic number? But the theoretical capacity is based on what the machines can do if they're running at full capacity. So to a certain extent, it measures, in a sense, what you bought, kind of the extreme capacity that you purchased. Practical capacity says, okay, well, fine, yes, we understand theoretical capacity, but let's make some adjustments for things like maintenance, things like holidays, things like maybe we're really only more practical only to run 2 shifts rather than 1 shift. Okay, and so that number will be less than the theoretical capacity. But again, it's based on what the machines can do, not based on what the market wants. Okay, so it's a more realistic number, but I'm kind of ignoring the market. So the temptation maybe would be to buy more machinery than what I really need. Now, the normal capacity versus master budget, okay? These are going to be based on demand. And normal capacity would be looking at my market, looking at my customers over a longer period of time, 3, 5, 7 years, kind of what the average amount. It kind of takes into account growth factors. I want to grow into my theoretical capacity. I want to grow into my practical capacity at a certain point. Realizing it's going to take a few years to get there, so I can adjust my present value calculations, my payback, etc., to accommodate that. Master budget is based simply on what's going to happen next year, and probably not a very good way to make a major investment decision. But certainly in terms of building the budget, the annual budget, as part of my planning process, very much in play with that. Now, what's the big deal with all this? Well, the big deal with all of this is how much cost per unit do I attach to each item that I'm producing. The higher that level of capacity that I'm assuming, the lower the cost. The lower the capacity, the higher the cost. But I have to get a return of all my cost. And herein lies the real problem. If I don't choose the right capacity, if I don't make the right choice, I end up with a lot of cost. And those costs have to be returned to me. And if they're not returned to me, then I'm not going to be very profitable. So the choice of capacity generally arises somewhere in this spot would be your so-called sweet spot, somewhere between 12 and 10,000. Now, you may only be at 5 or 6,000 right now. Maybe that's your market. But you think over a period of time that that's going to grow, okay, that I can increase my sales over a period of time to grow into that. So at the end of 5 years or so, we should be pushing up against that practical capacity. Then we can take another assessment of the market and decide whether we want to go back into the equity market to get financing to expand our production. If I overbuy, okay, then I have too much cost that has to be returned to me. I have the issue of I'm going to have to increase my price. I'm not going to be able to match my competitors if they lower the price. I also have the problem of opportunity cost. I have a lot of money invested in fixed assets that could be used elsewhere. If I choose to lower capacity, I'm going to end up being out of capacity very quickly. And I'm going to have to go back and incur large costs. Going into the equity or bond market to get that financing is very, very expensive. It's not cheap. So I don't want to have to incur those huge costs too many times. So the choice of capacity, and the chapter is really not about choosing it. Okay, as I said, this is really a marketing issue. This is where you have to trust your marketing people to have scoped out analytically what they think the market is going to be. Then we will base this capital decision on those estimations. Now, one final issue that comes up here. I think I've talked a lot about this. Okay. Okay, here we go. Okay, well, let's talk about, we forgot, let me find this. Okay, the so-called death spiral. The death spiral means that I overcharge for my product. And when I overcharge for that product, the demand falls. So as demand falls, it means, oh, I have less items that I can sell, therefore I have to charge more to get a return of all my cost. So while the demand of my product may be going down, okay, I'm essentially charging more for the product. So essentially I'm driving myself out of business. Not a very good proposition for a company.